Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 4th of November. We saw a rally in the US to finish the week. It did sort of peter out a bit on Friday night, but markets are really running on emotion at the moment, and there's plenty of irrational things going on, so it's pretty hard to be confident about where they're going to go in the very short term. As I've been covering, though, there is still no evidence to me that would support the case for a market top, a major market top, and we're into a bear market. I just don't see the evidence for that, either fundamentally or technically at this stage. But it's really important, I think, when we get towards these sort of periods in the cycle, which is it's very, very late in the business cycle, and it could be very late in this 10-year bull market as well, that you've just got to remain very open-minded. Don't get a fixed idea about where you think the markets are going. Just play it as it comes, and leave yourself positioned so that you can really deal with either eventuality. And I mean, that's one of the things that I'm trying to do through this weekend video, is to just provide a perspective that helps people shut out the noise and keep things in perspective. So markets are running on emotion at the moment, far more so than on fundamentals or rational thought. And so far, it's a pretty standard kind of correction as far as I'm concerned. The markets had got very, very deeply oversold by Monday night when there was some sharp selling in the US. So a rally from deeply oversold was very much to be expected. And the question is now, what is it that we should be looking out for? So I want to try and shed a little bit of light on that in this edition. Portfolio Analyst last week was very much about a perspective on global markets, and in particular looking at high PE stocks, not just here but around the world, because everybody's got them. And I did look at a local favourite, CSL, that CSL and Cochlear in the medical field have traded on very high PEs for decades and decades, and always will. But there are times when they get even more excessively valued. And so I looked at CSL from a long-term historical perspective, and it was actually quite surprising. I was of the view that with a bit of a reasonable pullback in price, CSL would come back into a buy zone. And I was a bit surprised when I really delved into it, just how overvalued CSL had become. And so I would have previously been happy to buy back into CSL around the $170 mark, but having done this further analysis, that level, to my mind, is still far too high, and I'd be looking for a much lower level in CSL to bring it back into reasonable territory. So it was a really good exercise, I think, and just a good reminder that sometimes markets can just sort of accept that certain stocks can just hang up there. And of course, we're seeing the Amazons and the Netflix and the Googles all coming back significantly. So let's move on. The American market was up 2.5% for the week. Little bit of a flat finish on Friday night, but it was still a pretty good week. But there's been a lot of technical damage done, and that's going to take some time to repair, because it really upsets people's view of where the market is going. And there's a lot of chatter out there about the fact that we're probably in a bear market, and that just all takes its toll. So I'm not expecting a sudden rush back up in the markets at all. And in this edition, I want to look at the similarities between where we're at now and where we were at in late 2015, early 2016, when we got a bit of a sell-off. And I actually did, for a period of about a week or two, I did actually signal through this service that I believed the bull market was finished, because we did break an important major swing low. Now, the market then immediately turned around and went straight back up again, and so 2 weeks later I had to reverse my call. I have no problem with that. There's no way that anyone can pick the market consistently correctly all the time. And I think far more important than the call you make on the market is the fact that you can remain open-minded, and if the market proves you wrong, then be prepared to instantly change direction. That's what happened in 2016. We're not even close to being able to make that judgment yet. So we'll just have to see how this one plays out. So flexibility and open-mindedness, I think, is just the most critical thing that you could cultivate, because no one really knows how this is going to play out. I mean, I'm sure there's lots of commentators out there that you're reading and you're hearing that have all got an opinion on where they think it's going to go, and people are going to run out all these terrific statistics that back up their point of view, but no one has any idea really. So just remain open-minded is the best advice I can give you. Now, in the US, earnings season is going along very nicely. The number of stocks that are beating expectations on profit is about 77%, which is right up there. The forward PE is 15.6, which is quite modest, so we don't have a valuation issue. Unless you believe that this is peak earnings and that from here it gets worse. But I can tell you that the analysts have been saying that we must be at peak earnings for 18 months to 2 years. And of course, earnings haven't fallen away. They haven't necessarily got a whole lot better, but they haven't fallen away. And I think the natural implication is if this is peak earnings, then it gets worse from here, but not necessarily. Earnings have remained very buoyant and very stable now in the US for some time. So at a forward PE of 15.6, I think that's quite reasonable. Next, the bond market is not supporting the negative view in the equity market. The bond market is quite stable. That's the smarter money in the bond market than in the stock market. And they don't seem to be too worried at the moment. And the final element is that inflation is under reasonable control. We don't have an inflation breakout that would cause the Fed to raise interest rates at a faster rate, which is what would concern the market. So for all those reasons, I'm not expecting that this is the start of a bear market, but I remain open-minded. The US dollar was slightly higher on the week. The trend is up, but I think we're going to see increasing volatility as we go forward. So let's take a look at some charts. So this is the S&P, and before I look at where we're at the moment, let's go back to January, February of 2016. So in keeping with the analysis that I've presented here many times, this was the first warning sign that maybe there was a change of character occurring. That occurred in October 2014, but then the market rebounded immediately. Now, this was a more significant decline than this one was for obvious reasons. It went deeper, it was sharper, and the highs that were formed were lower highs, whereas here we went straight back to higher highs. So this was a significant change of character occurred in August of 2015. We got a rebound, we bounced around for a while, we went down, we tested that low, and then that created a line in the sand for me. When you've got a low, that represents a change in the character of the market. So at that point in time, which was August of 2015, we can draw a support line and use that in the future. Now the market rebounded, almost got back to the prior highs, but not quite. And then we got a series of lower highs and lower lows. So you can see here that we've got this start of a downtrending channel. And then we got a further breakdown in the market. So this occurred in January of 2016, and we broke these swing lows. So that was the point where I made the call that I believed the bull market was over. Now that only lasted one day and we immediately rebounded, but we went down and we broke it again. So here we are by the 11th of February. I was still comfortable that we were now into a bear market. But lo and behold, 3 days later, by the 12th of February, the market has turned around and it just zoomed off. So the S&P here was around about the 1800 to 1900 level, which is 1,000 points below where we are now. So I was forced to reverse my call fairly quickly. And then, of course, everybody knows that the market has just continued to march on. Now, to me, this wasn't what happened in January, February, wasn't a change of character. This was just a retracement from an excessive blow-off that we got in January. We didn't even break the 200-day moving average. So this wasn't a change of character to my mind. Now, this is more of a change of character. So we're now sort of on alert as far as I'm concerned. Because we've had a bigger dip, we're under the 200-day moving average. The 200-day moving average has now started to roll over. So here's our line in the sand. So we can now construct that line and we see what happens from here. If we get a break of this low, which is around the 2600, then that certainly opens up the potential for the start of a bear market. But firstly, it hasn't happened. Secondly, if we were to get a short-term break of that line, then as we saw in 2016, it doesn't necessarily mean it could be a false break, as long as it recovers very quickly, as in as in a few days or a few weeks. But at the moment, we've got lower highs and we've got lower lows, so we have a downtrend. Now, I expect that we're going to get some sort of choppy trading action between these two levels, between 2600. Possibly we might go down and test the February lows around 2550. So maybe that comes down a little bit more. So 2550 to 2800, I think, is the range. And it's too early to say yet. We don't have enough information as to how this is going to play out. But if we get a series of lower highs and lower lows, then the odds of something more sinister gets bigger and bigger. So we'll just have to see how that all plays out over time. It's just too early to be making any predictions at this stage. So as a consequence, you should have modified your approach to the market, which I've been covering in recent weeks, and I'll just touch on that again when we finish. This is the NASDAQ. So you can see it's the same pattern on the NASDAQ, and we're still underneath the 200-day moving average. And finally, the Russell 2000, an even deeper sell-off in the small caps, and we're way below the 200-day moving average. So things not looking all that great in the small cap area. Now, as I've shown a couple of times, I'm keenly watching this ETF, FDN, which covers the internet, the 40 largest, most relevant internet stocks. So obviously includes all the FANG stocks. And there's been some significant selling here. If you look at the volume on this rundown when we first broke the 200-day moving average, there's no question this is a change of character. Will it stay above these lows here of 117? Or will we go a little bit lower down towards 110? I'm of the view, because of this volume that came out here, that there's some pretty heavy-duty institutional selling going on. And if that's the case, then it's unlikely to be complete. And therefore, 110, I think, is in play. And whilst ever we've got the FANG stocks going down, the S&P and the rest of the market is not going to go very far at all, because it's just going to impact sentiment. So that's my view of the US market. US dollar chopping around a little bit, but the trend is still higher. We managed to get a slightly higher high here during the middle of the week before a bit of a pullback. All right, the Aussie stocks, our dollar spiked up to 71.95, which was a bit of a mystery, to be honest. I have no real explanation for that one, so I won't even try. Uh, the ASX 200 was up 3.2% for the week, so very strong week. And at this stage, I think you can say that it's a big oversold rebound after just an absolute shocker in October, where our market was down more than the US. So not a real surprise to see that rebound. As I've been covering, I think there's a great deal of risk around high PE stocks around the world, whether they're good value or not. Anything that has a high PE tag on it is at risk of more significant selling. So just be very careful. My focus is very much on growth at a reasonable price, and also technically oversold. I think in this market, valuations and fundamentals don't count for nearly as much as they do in a more stable market, because there's just this irrationality of selling based on emotion. So not only am I seeking to buy stocks where the PE ratio is significantly below the very visible earnings growth rate, but we've also just gone through quite a hard technical sell as well, and that means that any profit-taking overhang that there may have been in those stocks has now been washed out of it. So I'm definitely in cautious mode at the moment in terms of stock selection and entries. Let's just have a quick look at the Australian market. Look at FXA first of all. So there's the Australian dollar. So a bit of a spike up on Thursday, and I have no real explanation for that. But as long as we remain below 73, we are still in a downtrend with lower highs and lower lows. And the ASX 200 looks that way. So we've come off at the start of September. We were trading at 63.50. Sorry. 63.50, we got down to a low of 5600, and then we've had a healthy rebound. But at this stage, we're still in an environment of lower highs and lower lows, so we're still in downtrend mode. While I'm here, let's look at gold on a weekly basis. You can see there was a bit of volatility in the gold price. Yes, it's moved up from around the 1180. We finished at 1233, 1234, but it's not really getting any momentum at this stage. At GDX, again looking slightly better, but it's a bit of a struggle for the international gold stock market. The Australian gold stocks, of course, Australian gold producers doing far better. So just whipping through this very quickly, gold was flat, and precious metal stocks just looking slightly better, but a bit of a struggle. Other commodities, copper was up a couple of cents only, despite the fact that supply and demand remains extremely favourable. We've got demand outstripping supply. We've got warehouse inventory levels down at 5-year lows, and still moving down strongly. So certainly it's in favour of higher prices over the long term. It's just really looking for a trigger, I think. Crude oil fell sharply again, down to 63, and this is about rising inventories, so that's a fact, and also fears of a global slowdown, which is more of an opinion than a fact at this stage. So we'll see where crude oil goes. So just in the back of my mind, are futures discounting too much, as we saw in the base metals futures just a month or so ago, when copper was trading down around the 250, 260 mark, and that sort of really defied the fundamentals. There is the spot copper chart. You can see just a little bit of a tick up last week, but it's been pretty stable for a while now. And there's crude oil. It's come off quite sharply, as you can see, over the last 3 weeks. And taking a slightly longer term view, we're back now to the lows that that we formed in May, June, July of this year. So it's basically taken out all of this little bit of a surge that we had in September. So to wrap it up, it's just too early to be or to form any strong conclusions about where the market is going. The snapback rally that we had this week is just perfectly normal. It would be amazing if it didn't happen. Personally, I'm expecting some more selling because I'm just seeing so much evidence of institutional liquidation of some of the market leaders or the former market leaders. And I just know that process takes time to play out. It just doesn't wash through in a week or two. So I'm expecting some more selling, and then we'll see how it settles. Obviously, looking at the nature of the pattern of higher highs and higher lows, and where the volumes are. If the volumes to the downside remain elevated, then it's likely that the selling is not done yet. For me, it's all about the trend. It's all about the charts. Forget about the rationale for why something should be happening. Just follow the trend, follow the pattern that the market is showing you, and if it seems irrational, then it doesn't really matter because that's the only thing that counts. Portfolio Analyst this week, I'm just going to continue to focus on building the opportunity list. When markets are doing this, it's when you really want to get active. You don't want to go into your shell. You want to make sure that you know what is a really good stock, a growth at a reasonable price, and then you have a bit of an idea of what a good technical entry point would look like, and then you just sit and you wait and you pick them off as they come up. But what you can't do is wait for the correction to finish and everyone to start to acknowledge that, yeah, the correction's over, because then it's too late. You don't have the time to do the research, and it just doesn't work that way. You've got to be prepared in advance, and that's what I'm putting a great deal of effort into in Portfolio Analyst, and obviously in my other services as well. Just a reminder, I had this slide up last week. In case you missed it, this is the ideal stock that I'm looking for. High earnings visibility because the company has strong free cash flow. It has earnings growth rate above 20% for the next 2 to 3 years, very visibly, and it's close to a base in its normal PE band. Most stocks and sectors trade within certain PE bands. A lot of them have been trading towards the upper end or even out the top of their normal band. CSL was a great example of that, where CSL normally trades in a band between around 25 and 33, 34 PE. Just recently was trading on a 47 PE, which is obviously, way above its normal maximum. And then we look for a meaningful sell-off in price to get rid of the profit-taking overhang, and that's the model, that's the process. There's my contact details for anyone that's not a member of any of the services, and I'll be back with you next week. Cheers.